Good afternoon, everyone. We would like to welcome you to our third RankiaPro conference call of the year. We would like to thank our three expert panelists for agreeing to participate in this roundtable discussion. Today, we are going to address the topic investment funds for uncertain times, where speakers will answer the questions: what should investors consider during these uncertain times? In times of uncertainty, what type of funds should we have in our portfolios? We are thrilled to have these three investment professionals who will share their extensive experience in the asset management industry and who will certainly provide a very insightful presentation regarding the topic. On, and on that note, without further ado, I would like to introduce you the expert panel. First of all, we have Austin Rovillard, Investment Director at Murdoch Asset Management. Agnew Vaju, Fund Analyst, Manager Research at AVN Ambro Investment Solutions. And finally, Patrick Polkart, Senior Investment Advisor at Bancavera. Okay, so let's get things started by briefly introducing each of our speakers. Austin Rovillard joined Murdoch Asset Management in July 2007 as a trainee investment analyst focusing on collective investment schemes, having previously worked on central operations at Torilo. He has spent his 14-year tenure at MOM as a fund selector, taking charge of the model portfolios in 2009, and worked his way up to investment director. Austin is a former top 30 under 30 with Citywire, and he is the reigning European Fund Selector of the Year with International Investment. Welcome to the conference call, Austin. We are really happy to have you here.
Thank you, I'm good to be here.
Next, we have Agnew Vaju. Agnew is an analyst dedicated to U.S. equities strategies in the manager selection team of ABN AMRO Investment Solutions. His responsibilities include the selection of funds. Between 2016 and the beginning of 2019, he covered fixed income managers. Before joining ABN AMRO Investment Solutions in February 2016, Agnew was a fund analyst on various asset classes at Fundquest Advisor, BNP Paribas. Previously, he also worked as an assistant portfolio manager, fund analyst at Bank Leonardo. Agnew holds a master's degree in financial markets from the Clermont-Ferrand Business Administration Institute. Welcome, Agnew. We are really happy to have you here.
Welcome. Thanks for the invitation.
And last but definitely not least, we have with us Patrick Polkart. Patrick is a senior investment advisor in the investment solutions team at Bancavera since May 2020. In this role, he is also responsible for the fund selection and monitoring within all asset classes and strategies. Prior to joining Bancavera, Patrick was working for 4 years at Raiffeisen Switzerland, where he had multiple roles and sat on various investment committees. Before joining Raiffeisen, he was working in the investment area of different private banks and held also managerial positions as head of asset management or head of treasury and fund research. Welcome, Patrick, to this conference call. We are really happy to have you here.
Thank you, Carla.
You're welcome. And now let's get this roundtable started with some warm-up questions. The first question I think is important and that most of us would like to know the answer to, and is as follows. The threatened inflation, the one that seemed like it would never come, has already been recognized even by Warren Buffett at the last annual meeting of Berkshire Hathaway. How is that inflation going to affect the markets? And if everyone agrees, Patrick, you can get started on this one.
Yeah, sure. Inflation, it is the hot topic these days. However, we think that this is just as we reach the top of the year-on-year base effect. If you look at the numbers, if you look at inflation on a biannual basis, for example, you would see that its development is much smoother, and especially in the US. It really shot up because we had basically the bottom to the high after the pandemic now from April to April or from May to May. And the US inflation is also historically are more commodity price dependent as global inflation, which acts much more stable if you look at the development in the past month and years. So apart from this cyclical move, we don't see structurally higher inflation in the medium term, because there are strong disinflationary forces which are still in place and which were in place before the pandemic. And these are obviously the productivity gains, which we have by a lot of new technologies. The aging population, which now obviously also will impact much the Chinese labor force. And then there is still global price pressure, which makes it hard for businesses to basically increase prices without having an impact on sales.
Thank you so much, Patrick, for your interesting view and opinion. Austin, do you have anything to elaborate on this topic? How are things looking in the UK regarding inflation?
Well, we had the latest figures out today, which showed that inflation had jumped from last month from 0.7 to 1.5, which is still below the Bank of England's 2% target. We do agree with Patrick that the figures that we're seeing are being, I don't want to say manipulated, but it's almost just a timing effect that's pushing it higher in the short term. Our concern on inflation would more be if it became persistent. The Federal Reserve and central banks have already said that they're quite happy, well, not happy, but they're prepared to let inflation run a little bit hotter for longer as we're coming into this recovery after the pandemic. So that's probably the bit that we would be more focused on. Yes, we're expecting inflation in the short term. As Patrick said, there are still the deflationary pressures that were there beforehand. In terms of demographics, and technology has always been price deflationary. But if it were to remain elevated for a period of time, that would really test the central banks and how prepared they are to let it run hotter for longer. I think that's a bigger risk rather than what the number is in the short term.
Okay, thank you so much, Austin. Agnew, please feel free to share your thoughts regarding this question also, please.
Yeah, I won't be really innovative because in the US market sees now 40% probability that inflation will be above 3% for the next 5 years. And market-based 5-year inflation expectation currently trade at 3%. Should we worry about the future inflation based on such expectations? We don't think so, because measured inflations do not signal future inflation. Usually they co-move with the realized inflation that currently is temporary peaking. Certainly there is some uncertainty regarding inflation in the next year horizon, with a very large fiscal stimulus, economic transformation towards sustainable economy, relocation in some extent of supply chain, while a lot of cash is available for households and firms. But like my colleagues, the medium term as usual disinflation trend, demographic, digitalization, and quality effects, low negotiation power for some workers will continue. In the short term, the slack of labor market is deeper than the unemployment rate suggests, and high savings is concentrated among the older and richer people with low propensity to consume. So inflation expectations are probably too high for us. Even in case of inflation above 2%, the Fed has already prepared the market for a very prudent and progressive monetary tightening, thanks to his new strategy, so the average inflation target and max inclusive employment. This is something to monitor, but not to worry. Thanks.
Okay, thank you very much, Agnew. Now, my second question would be, how the vaccine will affect the long-term market conditions? Do you think that investors will change their portfolios permanently due to the possibility of another pandemic, economic crisis, etc.? And maybe Agnew, if that is fine with you, you can continue talking and start on this one. Thank you.
Sure. First of all, how the vaccine will affect the long-term market conditions? It will depend on the long-term process generating new variants, and maybe the stop and go in services activity is the new normal. We believe that Israel and the United Kingdom, the major developed countries, are really under scrutiny because they have advanced vaccination campaigns. The US are also well advanced now, and they started to vaccinate kids. One scenario could be having a long-term expansion phase, meaning we will be just at the early stage of the new business cycle with slightly more inflation, economic growth. However, at ABN AMRO Investment Solutions, we believe that it will be quite difficult in the current environment to allocate aggressively in value on high growth stocks. And we would suggest to allocate more in companies with quality components, sustainable leverage, cash flow generation, etc. and so on. And on the fixed income side, we suggest to be flexible in geography, duration, and credits.
Okay, thank you very much, Agnew. Any expectations on this, Austin?
I suppose if I answer the second question first, do we think that investors will permanently change their portfolios? No, in short. If you think, we all have kind of a base behavior that we tend back to, and there are periods where that would be challenged. I'd liken it to you're driving down a piece of a road that you know relatively well, you're frequently on it, and you have a near miss one day. Well, you will adjust your behavior afterwards. You might drive a bit more slowly, you might take your time in terms of just checking your surroundings a bit more, but you will entrench back to your standard baseline. And we think that investors will do the same as well. This pandemic has obviously been a traumatic experience for markets, as we saw in Q1 of last year, whilst the subsequent recovery has been, for some assets in particular, have been fantastic. But we saw after the financial crisis that it wasn't long before people went back to doing what they were doing beforehand. In terms of the vaccine, I think it is, it's obviously our hot topic in terms of how quickly can we get people protected against COVID and how much damage is done to your economy until that happens. So I think that's probably where the crux of the matter lies. If it's going to take you 3 years to protect your economy, because you essentially haven't been able to protect your population, then obviously that's going to do some serious long-term damage. But if you are able to get your population vaccinated and return to normality sooner, then the longer-term effects can be negated, and you will get back to where you were. It'll just take a bit longer.
Okay, thank you very much, Austin. Please, Patrick, go ahead if you want to add something.
Yeah, sure. I mean, the vaccination, we just think that the successful global vaccination programs, they are a prerequisite for a sustainable recovery of the global economy. And it really has to be dealt with on a global level, because our supply chains, which are a bit troubled, they are also working globally. So this takes a bit of time, but I think it looks like we are doing great progress there. In terms of impact on investors' behavior, I make the same observations. I think it's not the pandemic, but the low interest rate environment, which we have now for quite an extended period of time, which had some changes to investors. So we think that they have an increased appetite for equities. So the TINA effect, so there is no alternative, might have some elements which could obviously accelerate a next downtrend in the markets a little bit, because people are running probably above their risk budget. And also there are signs that there is again acceptance for more illiquid and intransparent structures. And we landed up here in Switzerland with a couple of investors which not really realized that there is due diligence to be done, and then they landed up in Ruvercap and Greensill, and did not really understand in what they invested. And if they would have done the proper due diligence, they probably would have realized that there are some risks involved with these type of investments. So there we see some signs, but they're coming out of the low interest rate environment and not out of the pandemic. And what is interesting to us and makes the way back to normal in terms of rates a bit unlikely, not because we are so dependent on central banks, because now we are also dependent on government aid. if you look at the latest numbers, then you realize that 1/3 of household income in the US is now coming from the government. So there as well, we have a big dependence of the US consumer of the government, and so this makes a way back to normal where you can let the economy by itself and let it regulate by market forces seems very far away, which I think all in all is positive for equities still.
Thank you very much, Patrick, for your insightful answer regarding this question. Thank you also to Austin, Agno, and also Patrick for this little discussion. Austin will be the first panelist presenting. Please feel free to add anything about your background, and without further ado, you can now go ahead with your presentation. Thank you.
Yep. Thank you, Carla. So yeah, if we can move to slide 2 to start off with, just really talking about our approach. So obviously this topic of conversation today is investment funds for uncertain times. I will start off by saying every time is uncertain. We don't pretend to know what's around the corner. Sometimes some things feel more uncertain than others, but nonetheless, we still believe that the ability to forecast future events is not our forte. So with that in mind, how do we actually go about running clients' portfolios? So this is essentially just describing what it is that we do in that essentially viewpoint. So we are 100% active management because we believe that there are a small number of active managers who are able to beat their benchmarks on a persistent basis over time. So as a fund selector, I want to spend my time finding managers who I believe can fulfill that objective. So that's why we support experienced managers. What we're not looking for is somebody who can outperform every single year in every single time period forever, because there are so few of those around that your portfolio is going to hold no funds or one fund. So rather than looking for that consistency, we're looking for persistent outperformance. And you can only really measure that with somebody who has got a proven track record. So that's what we mean by experienced managers. So somebody who's got at least 7 years, ideally 10 years, but more importantly, have got at least 10 years ahead of them as well. The investment process is absolutely vital, because if you're working in an environment where you're essentially going, I don't know what's going to happen tomorrow, having a repeatable and robust process to analyze your companies and to build your portfolio is essential. Otherwise, you're just going to be, I don't know what's going on, and run away. So we want managers who have been there, done that. Their processes evolve but don't go through revolutions over time, and where you can see that it's actually generating alpha and adding value. We like to have focused portfolios, so we aren't buying hundreds of funds. We are buying a small number of funds where we have that confidence in the manager's ability to generate outperformance, and therefore that leads us to having a low turnover. So again, it's you find a manager and you back them for a long period of time, and it's based on fundamental research and analysis. So again, it comes down to, if I'm meeting a manager because we believe in active approach, then I want to know why they're holding particular companies, and the answer to be because they're the best to hold, rather than they make up X% of the benchmark, and if they didn't, then they would be taking too much risk, even though they think the company is absolutely rubbish. So we don't want to be holding those. And it's essentially like having a jigsaw puzzle. So if you go forward, Carla, the next bit, I've added a little graphic, because really all we're trying to do is take all these different pieces together and build the portfolios through it. So what I've just shown here is the risk allocation. So that doesn't mean we don't focus on the asset allocations, but I thought it would be a lot easier to visualize here in one slide how the different models that we run look from a risk allocation in terms of the low, medium and high breakdown. So any asset can have a low risk potentially, or medium risk or high risk. So all because you've got a fund, it doesn't necessarily mean that it's going to sit in a risk bracket. It's all about what the fund is doing from a fundamental basis. I should note that this is based on a Murdoch risk scoring system. It's been in development for about 12 years, and it's gone through hundreds of different iterations. And it's essentially trying to assess what can go wrong with a fund. The more likely it is to go bang, or the more likely you are to lose your money, then the higher risk it has. But I think it's useful to visualize, and certainly for us, when we're building a portfolio that, say, contains low risk funds, we're not wedded to just bonds. It could be potentially any asset class that's been through this robust modeling system that's come out with a low risk score. And the same with medium and high risk, that everything has to go through it in order to have that categorization. But it means that when we're selecting funds, we're not just comparing one bond fund with another bond fund, or one US equity fund with another US equity fund. We're actually selecting across every medium risk asset, or every low risk asset, or every high risk asset. So if we can go to the next slide, please. So say I've mentioned I'm a fund selector, and where I believe that fund selection really adds value, obviously having the correct portfolio, but in terms of actually what are we looking for at the fund level? Why do I get up every morning, and where do I think that we can make our clients better off with us than, say, with not having a fund selector? And it comes down to that long-term wealth creation, and it's all about the compounding of those returns. So I've mentioned previously that we're looking for active managers who can outperform. So we want to take that alpha and we want to grow it and grow it and keep growing it and keep growing it. We're already getting the beta by buying certain funds. So let the managers do what they do best, which is take the beta, add the alpha on top, and we should get a nice kicker. It's not always going to work, and I think that's probably an important consideration, because to be honest as well, it can be quite emotive when it doesn't work. But it comes back down, come back to your philosophy and your process. So if you genuinely believe that the fund you're buying is the right fund to buy, and the manager you're supporting is the right manager, and they run money in the right way, then if they've had a short-term period of underperformance, does it really matter? As long as you still have that confidence in the long-term wealth creation. You could switch and you could buy something else. You could be right, but you could be wrong. Whereas for us, it's if we strip out that short-term fluctuations and we let the managers keep delivering what they can deliver, that's what we're looking for. I've been told that I'm quite stubborn and lazy at a fund selector level, and I think that kind of helps, because if you're if you're backing managers for a long period of time, then you want to give them the ability to show that they can generate the performance for you. And I think again, understanding what you're buying and why is very important. Having an investment thesis at the start of it to say, this is what I'm looking for, this fund meets those criteria because of these reasons. It helps you analyze if those reasons have changed or if they haven't. And if that fund is going through a period of underperformance, it helps you understand, is that based on a fundamental change of the fund itself? In which case that's going to challenge your thesis and therefore your decision-making process, or is it more short-term market technicals that have gone against it? Obviously the value growth debate has been one that's obviously very high up at the moment. So if you're buying a value fund and it underperformed for the last 5 years when value's been out of favour, is that the fund's fault, or actually should you have expected that? Conversely, if you've got a value fund that outperformed, then you might actually be asking slightly different questions, going, hold on, you were facing these massive headwinds, yet you've done well out of it. Did you change your style in order to generate the performance? In which case that should actually be a red flag, even though they've done well. Or did they keep to their knitting and they've just demonstrated that they're a wonderful manager who have been able to generate excess returns despite those prevailing conditions? And then within the portfolio, it's having lots of different drivers of performance. So I mentioned earlier that we don't pretend to know what's around the corner. So therefore, how do we protect against what could happen? Anything that could happen. So by having a properly built portfolio that contains a number of different funds, number of different styles, but each one still having that focus and that direction behind it, then that can at least enable you to weather some of the storms that maybe have gone against you. So again, talking about the value growth, for example, by having both value and growth funds, you can still play the alpha that the managers are generating without leaving your portfolio open to being destroyed because of a market condition that's gone against you. So you can essentially protect on the downside while still keeping the core or essence of fund selection still there. And obviously within these frameworks, and as every portfolio manager will tell you, risk is an important consideration. You need to make sure that you're positioning the portfolio correctly, both from a concentration, from your styles, from your asset allocation perspective, so that you're not leaving yourself open to essentially one theme or one company or fund essentially destroying your portfolio and your performance. So if you are building an effective portfolio of funds that you believe in, that I think is the way that a fund selector adds value. And I mentioned the bottom alpha generation just to labour the point. And sorry to sound like a broken record, but if you're buying a fund that's invested in a certain asset class, you get the beta anyway. So what's the point in buying one fund over a tracker? Well, it's about the alpha generation net of fees. Next slide, please. And the reason I put this in is it is very emotive. And yeah, I started, as Carla said at the beginning, in July 2007 as a trainee analyst, which was a wonderful time, weeks before the credit crunch started to hit, and I didn't have a clue what was going on. And whilst it was a great learning experience, you are just seeing the emotions of your colleagues and the market. And it's understanding that we are human beings. There is a behavioural process that we go through when running portfolios, and we take it personally when things don't go right. But it's understanding that you will feel positive and negative around it, but it's making sure that you don't make stupid decisions when you are not necessarily in your best frame of mind. Q1 last year was a challenging time, and there were a few days when it felt like I was punched in the face and hit by a truck from what markets were doing. And it really was a challenging period, but I take comfort that we had a process that was well defined, has worked for many years, and we didn't make any changes to our portfolios whatsoever as a result of those short-term falls, and we were able to fully participate in the market during the recovery. Had we listened to ourselves and gone, this is absolutely horrible what's going on, and let's say that we increased the cash to protect our feelings, we would have lost out on the potential returns, and our clients would have been worse off for it. So I do think that it's important that people understand that yes, you're following whatever model it is that you have. There might be some stochastics in there. It might be econometric based. It might be maths rather than psychology, but we are human beings making decisions, and we feel good or bad about those. And particularly last week being Mental Health Week, this is a cerebral game, and understanding our emotions will make us better at it. And then just in the final slide, I've just showed some performance of what we delivered net of fees. Again, it's about that long-term performance. So you can see that over 3 years, most of our models have outperformed, but not all. But over 5 years, over 7 years, and over 10 years, we are ahead of our benchmarks net of fees across the board. And that is because of our focus and our discipline around finding managers who we believe are the best managers to be invested with. And we back them for a long period of time. It sounds very simple, and it really is simple. It's not easy, as Warren Buffett has said about the way that he invests money, but it is a simple process. So some of the fund managers that we have, particularly those of you in the UK, will be familiar with these names. So Richard Pease, he's been on our buy list for 25 years. We started following him when he was at Jupiter. We supported him when he moved to New Star, then to Henderson. He set up his own company, and we've been invested for that period of time. Over those 25 years, he's actually outperformed in 18 calendar years, or a 72% success rate. So it shows that he does have periods of underperformance, but if you back him for a long period of time, the returns that you can have from him is greater than what you would have had from buying the average European manager or the benchmark. Other long-term managers who we've been supporting, or funds that we've had in our portfolios for a number of years, include the now Jupiter UK Mid-Cap Fund. So we bought that actually the day it launched, which was the 22nd of February 2002. So here we are nearly 20 years later. It underwent a manager change in December 2008 when Richard Watts took over. we were there, supported him on that day, and you compare him to any other mid-cap fund, and I'd be amazed if there's one in the UK that you can buy that's outperformed what Richard has done during his tenure. And just the final fund, everybody talks about it, Fundsmith Equity, that's been on our buy list now for 10 years. And you look at the performance over that period of time, it's been advantageous to have it. It's had short-term underperformance of late, but again, it's coming back down to managers who you believe in, processes that are robust and repeatable, and supporting them a long period of time. You won't get everything right, but if you can get more right than you do, or more right than you get wrong, then you should have a good chance of generating excess returns for your clients than your peers. Thank you very much.
Thank you once again, Austin. I think this was extremely interesting. Also, I highly encourage the attendees, if they have any questions for Austin or about Austin's presentation, or also even for any of the upcoming presentations, please feel free to leave it in the chat box, and I would make sure to address those questions in the questions and answers period. Thank you. Okay, let's jump onto the next one. Agnew Verjus will talk about the US Value Strategy Fund and the Blue Bay Investment Grade Euro Aggregate Bond Fund. Agnew, this is your turn, and as I mentioned before to Austin, even if I have briefly introduced you, please feel free to add anything that you think could be interesting for our attendees. So please, Agnew, the floor is yours. Thank you.
Yeah, thank you, Carla. No, I think in the presentation it's okay. So just to introduce a bit the context, my firm, ABN AMRO Investment Solution, is the asset management arm of ABN AMRO Bank and a pioneer in sub-advisory. ABN AMRO Investment Solution has a proven track record in selecting mandates and third-party funds. And as Carla mentioned, I'm part of the manager selection team composed of 10 analysts that are specialized by asset class. A manager research process consists of a thorough analysis in defined 6 pillars: parent, people, philosophy, process, portfolio, and performance. And as we discussed previously, in the uncertain time, we can identify some potential headwinds, such as potential higher inflation, rising environment, volatility, but it can also add the pretty high valuation in the market, quality trade on the ESG best-in-class stocks, etc. So investors need something different than the markets, both in their valuation and ESG style, and with the flexibility in the environment. So we introduce two strategies, one US equity and a fixed income one. So last year, we have selected Boston Common to manage a sustainable US value equity mandate. The philosophy of the strategy is clear. The investment team seeks high quality, sustainable, and undervalued stock that fall in the following categories. First, undervalued quality company, the company that generates cash flow but with a discount, potential turnaround, former successful company experiencing business challenges. Third, companies in improving industry. Fourth, improving fundamental and ESG trends, companies that making positive changes. For example, Boston Common have engaged with the banking sector to improve their carbon risk. And last but not least, companies whose leadership in product or services provide ESG solutions to ESG issues that are not adequately valued by the stock markets. Sustainable investing is the DNA of the firm, which is a pure responsible investor. They seek to invest in companies that provide solutions toward environmental and social challenges and that have defined sustainable themes which they invest. So climate change and energy renewable, inclusion and human rights, health and community well-being. So the ESG team identifies both ESG leaders and companies with ESG momentum, meaning companies willing to improve their ESG characteristics or in the process of improving their business practices and solutions leader. The goal of Boston Common has always been to improve business practices related to environmental, social, and government issues. They use their voice as a shareholder to raise ESG issues with management through a variety of channels: engagement, multi-stakeholder initiative, proxy voting. They use their engagement as an alpha source to unlock the value of the company. So we appreciate that the firm has a clear sustainable philosophy and one dedicated team to apply it. Now in the next slide, I will introduce briefly that process. So the initial universe is filtered on market cap, liquidity, quality, and ESG metrics. This screen excludes companies that have consistently lose money, an unsustainable level of debt, or from an ESG point of view, violated labor standard, etc. So Boston Common further refines this list by judging the quality of the remaining companies. Analysts cover global sector in which they have developed a specific expertise. They are focused on the understanding the long-term value drivers for both at the company and industry levels. They look at the development across an industry to understand pricing trends, product cycles, supply demand, etc. So the investment team looks for higher quality organization with consistent, visible profitability and free cash flow generation. They try to identify companies that are trading at discount to their intrinsic value and have a potential catalyst to recover. So held by the ESG team, the investment team integrates ESG factors at every stage of their research. Both ESG and fundamental processes are done in parallel. So the ESG team identifies the companies that are improving their ESG practices based on their proprietary sustainable process. They don't rely on the third-party data vendors, and this enables the team to exploit some inefficiencies from large ESG data providers. So next slide, please, Carla. So the in-depth fundamental company and ESG research result in a focus list on 175 stocks, and the portfolio manager select 50 to 70 stocks from a focus list to build a fairly concentrated portfolio. And to give some other characteristic of the portfolio, it's a fossil fuel-free strategy. They reduce by 50% their CO2 exposure versus their reference index and target a high active share. This portfolio is composed of best-in-class and ESG momentum stocks based on the ESG practices and solution leaders. Boston Common Asset Management is a unique majority employee-owned US-based responsible investment boutique. The firm was founded in 2002 by Gita Iyer, who is the lead portfolio manager of this strategy. Stephen Heim, director of ESG research, and Lauren Comper, director of engagement, have multiple decades of experience. The core of this team has been working together since the mid-90s, and the investment and ESG team totalized 16 people with a lot of experience. Gita is one of the pioneers and thought leaders in the responsible investment community. And for example, she was a member of the board of the UNPRI. She has almost 20 years of track record on this strategy. We very much like boutique structure as we believe that we can find the most talented investment people in independent boutique, which are employee-owned. Equity have to be distributed among the entire investment team in order to have an alignment of interest with our clients. So to conclude in few words on this strategy, it's a high quality value strategy with ESG momentum and strong engagement effort as one of the alpha source. And since inception, it's a solid track record versus the US value index, especially during bear markets, which fits with the uncertain environment. As it was mentioned previously, I have also an experience in the selection of fixed income managers. So it's always difficult to talk about fixed income in uncertain period, especially like the beginning of this year with the rising environment. So I wanted to choose a European fixed income manager as this asset class is almost in all strategic allocation of European clients. And to choose the strategy, I wanted something which is flexible in duration, credit, geography, and even currency. So I decided to talk about the Blue Bay investment grade fund that I've selected years ago. So if you can go to the next slide, Carla. So the investment team believes it's possible to generate alpha through an active portfolio management while minimizing downside volatility. They have a total return philosophy using both long and short exposure to reflect that focus on capital preservation. And their process combines top-down portfolio themes with active country and bottom-up issue selection. So then, as you can see here, the investment process combines different stages. They can invest in bonds issued by the Eurozone governments and also in other countries in euro-denominated bonds, such as Iceland, Macedonia, Mexico, and so on. And on the credit side, they invest in European companies, but they also have the expertise to invest in US issuers, which issue in euro. So the first stage consists of research inputs combining top-down, fundamental, and corporate sector level trends research provided by the specialists of various asset classes. Their goal is to determine a macroeconomic strategy. Country economic and political analysis are the main source of sovereign trade ideas generated by the portfolio managers. Then, in the idea generation stage, the team members analyze each alpha source considering the fundamentals, valuations, and technical factors. Relative value analysis concentrates on the spread versus comparable credits, cross-currencies opportunities, and fiscal securities versus CDS. And following this stage, the alpha source outputs are created in the form of numerical rating scale from +3, so the most bullish, to -3, the most bearish, allowing a uniform calibration of strength of conviction and size of the expected move in the underlying asset class. So if position decision is accompanied by targets and a stop loss level, and it's adopted in all of the process. And so the strategy adopts a collegial approach to the management of the fund, and all members of the team continually to share and develop investment ideas in a cohesive manner. This output defined by the committees influence the risk position of the strategy, such as beta, duration, exposure, sector exposure, and regional allocation. And the strategy generated as a high amount of out-benchmark exposure, particularly in non-euro emerging market countries, still in euro-denominated debt, Central Eastern Europe, for example, but also in the G4 rates. In the fifth stage, the portfolio construction, the portfolio manager drawn on the strategy designed to determine appropriate position sizing based on their conviction, so the +3 to -3. And outputs are evaluated alongside the market correlation in the context of a top-down macro view to optimize asymmetry of risk. And position sizes are governed by its set limits on interest rate sensitivity, the DV1, the credit risk sensitivities, CDV1, and sensitivity to FX movement. So they manage for a small bucket on FX active risk. And which we like also is that the P&L is monitored on the roughly on daily basis to review the stop loss levels. And to generate the performance, the investment team uses almost all of the alpha sources that they can have: global duration, sovereign beta, sovereign alpha, credit beta, credit alpha, and forex. So next slide. So what we like is the team of Blue Bay. It's composed of 28 investment professionals that are led by the experimented Mark Dowling, which is the lead portfolio manager of the strategy. Macroeconomic analysis is undertaken by sovereign portfolio managers as part of their portfolio management duties. You have Mark Dowling, but you have also some other Russell. We manage some emerging markets. So we have a strong view and share ideas between on the view on the G4 rates. And they have a strong expertise in analyzing global rates and countries for the past decades. So the team is composed also of credit specialists specialized by sectors. Mark Dowling is specialized in G4 rates, Euro periphery, and asset allocation for a while. The focus on policymakers and political environment of countries, the depth and quality of the insight generated by the Mark Dowling is a really competitive edge in this asset class. And the two decision makers uses the global ideas from the different macro specialists. They also use credit inputs for the experimented credit sector specialist and the credit analyst. And what we like also is the ESG is more integrated in the credit analysis, both on the countries and corporates. And in terms of performance, so the downside capture ratio has been almost constantly below 100. On the other side, the upside capture ratio has been above 100, which is indicate that the fund has a good downside protection and a good upside. And CTIP session is a really solid long-term track record versus a European aggregate index. So to conclude in a few words on this strategy, it's a flexible total return approach with a different alpha source. That's what we like for this uncertain environment. So thank you.
Thank you very much, Agno, for your very insightful comments and presentation. Also, a kindly reminder that if you have any questions, please feel free to leave them in the chat box. We are going to end with Patrick Bolkart. He will present the Flossback Bond Stock Bond Opportunities Fund and the Allianz Global Investors Allianz Strategic Bond Fund. Patrick, as I did with Austin and Agno, please feel free to share more about yourself or about your current position at Banca Bera or anything you think is important. And yeah, with further ado, you can start now your presentation. Thank you.
Yeah, thank you, Carla. So what concerns me is perfectly covered by you. So we can dive into the presentation. You can go on the next slide. Yeah, just as a general remark, obviously, if you have uncertain times, we think two things are important. One is obviously risk management, which is essential. And on overall portfolio level, we think that diversification is very important because, as we heard before, you never know what's coming around the corner next. And if you have a concentrated portfolio, there is more risk that you're on the wrong leg. And this is also true. I mean, if we select actively managed funds, we try to get a good mix of different strategies, which have also then kind of a protective and diversifying feature within the overall portfolio. Then the most obvious solution which came to my mind for uncertain times was obviously the addition of CTAs, because for us they are a clear risk management tool and can very well act as an overlay. As an example, I would like to mention SEB Asset Selection Fund. It's a single manager fund, but very transparent. It's a UCITS, and it doesn't invest in commodities. So actually, what you can get there is an overlay which actively overweights or underweights your equities, your bonds, your FX in the portfolio. The problem with that, in our experience, was the implementation. So basically, to get an adequate result, you need a 20%, 25% allocation to the CTA. And in order to do that, this is feasible for institutional investors. You should basically put it in against the credit and leverage your portfolio. And if you have to add it into the portfolio, it's very difficult because they are funded investments. So you have to basically reduce the portfolio to put in the CTA. And so basically, at the end, you're not really getting what you were looking for. So at this point, we don't use CTAs due to that reason. But we felt there is a lot of action needed in the investment grade space, which historically was about a 30 to 40% allocation in our portfolios. And now it's basically a zero allocation, because we found it difficult to explain to our Swiss franc investors that they should allocate that much money in an asset class which will return by maturity with certainty a negative return, and doesn't really show anymore the positive correlation behavior against equities at these low interest rates. So therefore, I would like to present two complementary flexible bond funds, which I think are a good replacement for the investment grade bond allocation, and which work very well together. So you can go on the next slide, please. So the first one is the Flossbach Fondstorch Bond Opportunities. In our opinion, it's the best performing traditional flexible bond fund. I like to call these traditional flexible bond funds because the peer group is quite highly correlated amongst each other. What is striking is that Flossbach achieved a very good performance compared to the peer group over the medium term, and that it applies an absolute return mandate without the benchmark. So a lot of its peers probably have as a benchmark what we use, something like 60% investment grade plus 20 high yield plus 20 emerging markets, which makes them more behave like credit funds and lose on the downside, like at the beginning of the pandemic. Whereas Flossbach could very well contain the losses, as you can see on the performance chart. So you can go on the next slide. And if you look at the alpha, as I mentioned, they have no official benchmark, but if I compare it basically to the global aggregate, we have about 3.1% per annum over the last 3 years. And I think the points which led to that good performance is a good sense for risk management, which comes due to their absolute return mentality, which makes them look for opportunities which are really worthwhile to invest, and not just because it's benchmark. And then what is also very interesting is their holistic and integrated research approach. So they have also multi-asset products, and the analysts, they work all together across the asset classes and are also portfolio managers by themselves, which gives them a really good feeling how the research works into the portfolios, and leads to this very solid results. Otherwise, they are very transparent in what they're doing. So basically, they organize bi-weekly calls, which you can really see what they are thinking and how the portfolio is developing. So there are no surprises if you invest with them. And the process is driven top down and bottom up. So I would say it's about equal important in terms of alpha creation. They look for obviously liquid investments only, and then the alpha sources are rates credit, where they invest only above B minus, so they don't go into deep high yield, and inflation and currencies. So that was the first fund, and as I said, the problem is that if you add another flexible bond fund, you risk that it's highly correlated to this one, so you don't achieve really much in the portfolio. And therefore, you can go on the next slide. We like Allianz Global Investors Strategic Bond Fund very much because it has quite a bit of different approach. And it's run by the global macro team at Allianz. And what they're trying is, first of all, they defined the global aggregate as basically being the benchmark. So they want not at all to be a credit fund. Because additionally of being flexible, what they defined is they want to have a zero correlation to equities. And a maximum correlation over the 3-year rolling window of 0.4. So, which means they cannot act like a typical credit fund, which always is strategically a bit long credit. So basically, strategically, they want to be net zero credit. And therefore, they're looking for much more for relative macro-driven, top-down alpha opportunities than just to basically try and overweight and time different credit markets. And with that strategy, they were not only able to prevent losses due to the pandemic, which you can also see on the chart, which is a bit shorter because the CHF share class is not that long on the market yet. So they did not only prevent losses when the pandemic started, they were able to produce double-digit positive returns, which exactly is an outcome of their strategy, that they are not long credit. And here in this case, they could obviously use the big moves on the credit side to make money out of it by having short positions. Here as well, very important for them is that they stay completely liquid. So whenever they do trades on the credit side, it's mostly over CDS. So you can go on the next slide. Thank you. So in summary, obviously the alpha was really striking. So it was almost 11% over the last 3 years analyzed. And the correlation target obviously was steadily maintained. There were periods where obviously the correlation was much higher. So for example, you saw it when the recovery took place after the pandemic breakout. Obviously the correlation to equities went longer because they turned around the positions. And they are looking really much to look at opportunities which have asymmetric payoffs, which means that at this point they would probably never go long credit, because there we have also very asymmetric chances looking forward, but not to your favor, as credit spreads are that tight. So the upside is very limited, but obviously there is quite a big downside if suddenly market conditions should change in credit. And here as well, the alpha sources are also very well diversified. So we have also rates, credit, inflation, and currencies. And for example, inflation we had as an intro topic. So on the inflation side, if you look at the inflation-linked bonds, they would rather be short because there as well the market price is in already a lot. So you should have been long probably a year ago. At this point, you get about a -1% real rates return on US debt inflation linkers, which is very expensive. So that was basically the second fund, and obviously, if you put them together, you get a very interesting and neat profile, as they work very well together, and give you, despite the low or even negative yield environment, a really good chance to get positive returns on your fixed income allocation. So that was it.
Okay, thank you very much, Patrick. This was another insightful presentation with really interesting recommendations. Okay, it seems that we are almost out of time for today, but I would like to squeeze in one question from our attendees. The question is as follows, and this question will be for all of you. If you, as speakers, can please touch the topic of private markets and private funds, such as private equity and private debt. And I think I will follow a chronological order. So Austin, if you can answer first, thank you.
Okay, so currently we have no exposure to private markets, private debt or equity. That's not because we don't think they have a place in the portfolio, it's just from a fund selection finding the right home for it. As Patrick mentioned, liquidity is very important, and as we've seen from the Woodford blow up, what happens, and also from property funds, what happens when you have a mismatch between your underlying portfolio liquidity and the liquidity you offer your investors. So I suppose what that essentially leads to is investment trusts are your only option, and then it's finding the managers who have got proven experience of running money in that space over a significant period of time, and at present we haven't really found anybody who ticks the boxes for us. We are quite qualitative in our approach, so it's all about the people and how good we think they are, and it is quite slim pickings for us. I appreciate that others might have more investment powers, they might be able to buy different products, and we would be able to. At the end of the day, our clients are actually retail investors, so from a retail perspective, that there just aren't many, but it is something that we are looking at.
Okay, thank you very much, Austin, for your opinion regarding this question. Agnew, do you have anything to add? Thank you.
No, really, because we don't really allocate in my team to this expertise. That is really something that you need someone to be on the field. Even if you have a big team, we only look at the kind of impact illiquid we search some bonds, but it's something that is really for the really high net worth clients, and it's not something that we push for all of the retail bank.
Thank you, Agnew and Patrick. Do you want to add something?
Yeah, it's quite similar with us as a regional bank. We have predominantly retail investors, and there might be some solutions out there which pretend some liquidity, but in the end they are gated and have not the liquidity you ask for, and then normally you get bad experiences when too many investors at the same time want to exit the strategy. So yes, it's important. Yes, the liquidity gets you some premium, but it's really for sophisticated investors. And the most important thing, and I mentioned it before, because at previous employers we were running private equity portfolios, but you need really a good team or then a partner who does all the due diligence work and really looks into the details. And with due diligence, I mean not only the due diligence on the manager and the strategy, but also on the operating side, because normally these are offshore vehicles, and there are a lot of different risks involved which you obviously don't have in like the UCITS space. So these are reasons why we do not consider these investments at this point. There are some trends by digital platforms which make private equity more accessible, more liquid, and probably also will establish a secondary market. So I could imagine that probably 3 to 5 years down the road, it's getting a bit more investable also for smaller clients, but at this point I don't see any opportunities.
Okay, thank you very much, Patrick. We could be here for much longer, but unfortunately, we are out of time for today. However, I just wanted to say a huge thank you to the attendees for joining us and to the expert panel. Thank you so much for preparing these really insightful presentations that will provide us with so much information on the investment funds that investors should consider during these uncertain times. And let's hope that this discussion on these really interesting topics gets growing, and we look forward to seeing all of you in our next conference call. Thank you so much, everyone, and have a nice evening.
Thank you.
Thank you.
Bye-bye.